Thank you, Roger. And what I'll be talking about today is a little bit kind of picking up where Roger left off. And unfortunately, we don't have the time to do all the heavy lifting we'd like to with topics such as alternative investments, because they've become more prevalent, but they've not become any more simple. They're a little bit difficult to understand compared to traditional investments. And there's a lot of different strategies that can be dealt with inside there. So I'd like to go back to the basics. Rod already took us back to the basics and talk about the traditional investing and how we think about how you could set up a portfolio to succeed. One of the first things is you base that portfolio on your spending needs. So how much do you need to draw from that portfolio is an important determination. And so if you're not retired, if you're 10 years or 20 years from retirement, you don't have a lot of spending needs from your portfolio. So that can help determine how you're going to set up that portfolio in terms of growth versus income. If you're at or near retirement age, the spending, the withdrawal is much closer, a much more important part of what you're going to need. The whole dynamics, the whole mathematics changes when you're drawing steadily from an investment portfolio in terms of how to manage it well. So we would like to see people map out their specific needs rather than go by these rules of thumb that talk about 4% withdrawal rates and things like that. So we work hard at that. We want you to figure out when you're going to take the trips, when you're going to need a new car, and what your monthly and annual spending is over the next 2 to 10 years. And then we can get a better investment portfolio designed to meet the needs of that demand over that 2 to 10 year period. We also like then to see a balanced portfolio strategy. And that helps to reduce this market volatility issue. So balance between stocks, bonds, cash, and other things. Provide some negative correlation. Negative correlation translates to not everything in one basket and different asset classes moving at different times to your advantage. So balance reduces volatility and it moderates total return. So that means if you're going to do this balance thing, you're not going to get as high a return as if you were all invested in stocks. And we think that's one of the best things you could do, is not try to do that. There's a few people who can do that, but they are getting income from those stocks, and the income's meeting their needs. The last thing is purchasing power. So you need to invest so that you can maintain purchasing power, because most people live in retirement for 20 or 30 years or even longer. So in order to meet your spending needs and the purchasing power that you need for that long period of time, you need to invest so that you can stay ahead of inflation, or at least stay up with inflation. So we focus on real return. What is the inflation-adjusted return? And we're willing to trade some of this volatility for a longer-term success. And that means balancing out a portfolio. So that's sort of kind of the basics that we preach and teach and help clients find their way to. Why is this so difficult right now? Well, Raj has already talked about the S&P index. Here's a graph that does go back to all the way to 1965. It's one that we've shown in prior years at this event. So what you see in the blue is you see the S&P 500 index, and what you see in the tan, looks like color, is the 10-year Treasury rate. So you can see where the real peak, where it really stands out, is that 1980 period when interest rates reached their peak and started falling. And at that same time, S&P prices were at one of the lowest times in this period, certainly. Since then, stock prices have advanced, bond yields have come down. So, and those things are very closely related. Falling rates help stock market return. Why is that? Well, because corporations don't have to pay as much for their debt. And so they can bring more earnings to the bottom line, and that helps. And but there's a negative side to that as well. And all of us are sitting here kind of feeling that right now because we're at this super low spot in the interest rate cycle. And the 10-year Treasury rate is as low as it's been for a very, very long time, around 1.9%. Roger just talked about normalizing at about 5.5%. And so we all hope that we get back to normal, but what price will we pay to get there is a good question in terms of your investment plan. And also you can see on this graph that prior to 1980, rates were increasing for about 15 years, same time period Roger just mentioned. 15-year cycle, so rates going up for 15 years. Since then, rates have been coming down since 1980. Rates have been coming down. We've only just in 2013 finally seen a little uptick in that. We're kind of feeling, a lot of people feeling like we're at the bottom. Like rates can't go much lower. When you get to 0% on Fed funds rate and things like that, you know that rates can't go too much lower. So how do you choose a good investment plan? Basically, how much do you need to draw from that? And when do you need it? So if it's sooner, then you need more access to investments that aren't going to be fluctuating so much so that you're not giving up gains or giving back capital that you need not to. So bonds and cash play an important role in that. Real estate can also play an important role in that, especially if it's producing good cash flow, good steady income. You can be an individual owner of real estate, you can be a corporate owner of real estate by owning shares of real estate companies these days. Also monitoring tax impact is very critical. And Greg and Aaron just went through some of the complexities of this new tax law. So it helps to know before you launch into an investment plan, what are the likely tax implications? What are the likely tax drags on that particular kind of strategy? And then finally, considering expenses, the cost of investing, as many of you know, can be a significant drag on your total return, and can be enough of a drag on your total return that can kind of spoil the plans. So you have to be able to keep prices down. You have to be able to keep your costs down. And when we start talking about alternative investing, Raj has already made the point that these things carry higher than normal fees. Oftentimes you're paying fees that are 2 or 3 times what you'd pay to own a good stock fund or a good bond fund. And so you have to say, well, am I getting my money's worth out of that? And it's important to consider that cost factor as well. What we want to see is we want to see quality management at a fair price. So if you're not able to make these decisions month to month, year to year yourself, you need to get some help with that. But you need to be cognizant of the cost of getting that help and what the impact of the help is bringing to the bottom line in terms of your investment results. We know there's some very good mutual funds out there, some very good management that exists in the public world, as well as some very good private management. Last year we heard from one of those private managers, and that system still works, but works better when their fees are reasonable versus unreasonable. So if we look at different kinds of periods of time, and we measure what the performance of bonds and stocks has been over those periods of time, is quite interesting. So what this graph portrays is that you have on the left-hand side a period of rising interest rates. The next one over to the right is neutral interest rates, then falling interest rates, and then over a full period. A full period in this case starts in January 1926 and ends in August of 2013. So if you want to go back, now we're really back there, 1926. But this graph then shows intermediate term government bonds, which is the lightest color, long-term government bonds, which is the orangey color, long-term corporate bonds is the more reddish, and then high-yield corporate bonds, which is blue. And then the green, which is the 30-day Treasury bill. If you just glance across the page, you can see the green has been the most stable of all of those, but also the lowest producing yield. So the point of this is that where are we now? Are we in a period of rising interest rates? Well, we've had an uptick. Since summer we've seen rates, 10-year Treasury rate come up some. Is that a trend or is that a blip on a longer graph? We're not sure yet. But again, we know that rates are in these historic low places. So the prospect of rates rising is probably a lot more probable. And so we could maybe call ourselves a neutral interest rate environment right now. You can see in that kind of environment, just as we're experiencing, rates are pretty low across the board. When we go into rising rates, the issue and the concern is the negative returns from bonds. And you can see negative returns from bonds, and that has happened before, and we need to be careful and understand that that's coming at us, how to manage those bonds. Rod has already given you the formula. I subscribe to the same formula. Whenever possible, you own individual bonds so that you can hold them to maturity and preserve your capital in a period, especially in a period of rising interest rates. So we've been advocating for that pretty strongly in the last couple of years. Next graph is stock performance. Stocks also can produce income and also produce historically some appreciation of your investment. Again, rising interest rate environment to the far left can produce negative returns in stocks, but typically only the highest dividend paying stocks are the ones that really suffer. And that's logical as well, again, because interest rates are rising, dividend rates that are high to begin with need to be cut back, and the price of those stocks can fall for that reason. So stocks that are paying no dividends are actually the stocks that do the best in a rising interest rate environment. Does that mean you should have all of your portfolio in stocks that pay no dividends? Probably not. We've long advocated for dividend-paying stocks and think they're a good part of a permanent portfolio. As you can see, over this 85-year period of time, over the full period return on the far right, dividend-paying stocks still win. But we may be headed for this period on the left, and you need to be careful and kind of adjust portfolio management to account for that. So the non-traditional investments, alternatives, there's all sorts of different kinds of them. They act in different ways, in different kinds of environments. Some of them produce income, but more emphasized on capital appreciation and as a negative correlated thing to other traditional investments. It's important to keep in mind that the underlying investments behind all of these alternatives is the same basic stocks, bonds, and cash. They're just put together in a different way. For example, if you hold a short position in a treasury bond, that means if the bond price goes down, you win. Okay, so we think that bond prices may be going down as interest rates rise, so it might make sense to have some money invested short in bonds. It's pretty aggressive, but with a small percentage of your portfolio, you can help balance things out. You can help smooth the ride a little bit. This is a graph that shows 14 different asset classes, most of them alternatives, a few of them traditionals. And the ones that stick out, and from left to right, it's the 1-year performance, the 3-year performance, the 5-year performance, and the 10-year performance in terms of compound returns, okay, annualized returns. You can see there's a 60% gap between S&P 500, the winner over the last 12 months, and then the precious metals commodities, the big loser over the last 12 months, a 60% return gap. But you can also see that as you move to the right, you've got that gap narrowing along the way. And asset classes sort of revert to what we call gravity. And what happens is that negative correlation that looks so wonderful in year one starts to really fade and diminish over a period of time. So again, what are we paying for when we're paying those higher fees? If we're expecting long-term higher returns, looks like we're not maybe getting as much as we might expect to get. And that's a very important point to be made about using alternative investments. They can serve a purpose, but because of fees, they can not perform as well as you might expect in terms of their relation to traditional investments. So if you're assessing risk and looking for, what should I do? Which one of these should I even be considering right now? Again, considering the times is really important. And if you look at this table, you'll find various market conditions, increasing market risk on the left, decreasing, then rising inflation, increasing market volatility, and rising interest rates. Those are all sort of different dynamics that can occur in various markets. And you can see which of these alternative investments might best apply in those kinds of environments. So that's one of the most important things, is to kind of match up the times with a strategy. And then it is true that these programs that used to be only available to institutions are now available to all of us. In fact, the mutual funds that you probably own right now, those managers are doing some of these things inside those portfolios. So you are probably using alternative investments if you're invested in mutual funds, whether you know it or not. And the question is, how much do you want to concentrate on that? And our best advice to you is that you really need to understand them better. I wish I had another half an hour to go through some of the details of how these various instruments work. But unfortunately, we don't have time for that today, but be more than happy to talk to anyone who's interested about that. There's separate instruments available now that can produce these strategies, and they're tracked publicly. They're tracked in groups and in programs that service like we own, as Morningstar, etc., will be able to give us good information about historic performance as well as about portfolio makeup. So we're happy to accommodate your interest in that. We think there's a place for them. We're sure that if you can find your way to them and keep your fees down, that you can succeed. That sort of concludes what I have to say, except to talk about Bitcoin. We're going to spend another half an hour on that. How many of you are Bitcoin owners? Nobody owns Bitcoin. Well, one person does, all right. How much will you sell Bitcoin for us?
Good question.
They're worth about $800 right now. In the summer, they're worth about $13. So if you want some entertainment, go Google Bitcoin sometime. It's like phony currency, but it's working. So the alternatives are endless. Thanks for your time. I think we have time for some questions and answers.